Hey guys, what's going on? It's Marco, aka MercFX, and today I'm going to be talking about prop firms versus your personal capital. So, short term cash versus long term performance. Here we go. All right, so first off, if you don't know what a prop firm is, pretty much you're trading someone else's capital or like a business's money. Um, it's simply just not your money. You follow strict rules, so daily drawdown, max loss, profit targets to actually pass them. Um, just strict rules based totally. Like the decision is based totally on the company. Profits are split, and so it's usually around 70 to 90%, more closer to that 80 to 90% per trader. So that's pretty decent. And the thing is, accounts can be terminated instantly. So if you don't follow the strict rules, um, really like it's not super regulated, and they can just take away your account with some pretty crappy rule, and that's it. Like you just don't have that account anymore. It doesn't matter how much you spent on it, how much time you spent on it, whether you got a profit or payout, whatever it might be. They can just you can wake up one morning and they can be gone. And pretty much they're designed for risk control by the businesses and the companies like the prop firms, not for trader freedom. So it's that the reality of prop firms. So thing is, prop firms are great. I mean, you get access to tons of capital that is unimaginable for most people. I mean, you can buy 100K account for $1,000, 50,000, whatever it might be. You can start with 10K accounts. You can start with 50s, 200Ks, 100Ks. I mean, there's so many options you've got, and not everyone just has 100K sitting in their trading account. So it's a great way to access the capital. But the problem is, you're trading under constant pressure. So like your risk is normally very low just because you don't want to hit daily drawdowns. So pretty much forces you hit targets fast. So those profit targets they've got, and avoid drawdowns at all costs. So once you hit like there, it's normally 5% daily drawdown or 10% total drawdown. I mean, done. Like one bad day and it's gone. And it encourages over trading, scalping, and short term. Look, I don't have any problems with scalping, but um, I think it encourages bad trading habits, rather than good trading habits. So yeah, as I said, one bad day can mean that your account is totally gone. So why prop firms are great for short term cash. What they're great for stuff like paying bills, funding lifestyles. So the odd payout here and there once a month, once every 2 months, twice a month. Um, Funding more of your lifestyle sort of aspects. So new pair of shoes, I don't know, car, whatever it might be. Just some extra cash on the side if you've got a daytime job or whatever it might be. Not great for compounding and then long drawdown periods. So as I've said previously, those daily drawdowns and those max drawdowns. I mean, you got to try a lot to avoid that, because if not, you'll just get the account um, taken away from you. The account, you'll blow the account. Pretty much, you're renting opportunity. You're not owning it. So as I said, you see that 100K in the account. That's not yours. Um, it's just simply not yours. You can't withdraw that. It's not yours. You're renting that. Personal capital. So trading your own money. So this is where it gets a bit tougher. The thing is, I always recommend having a job while you're trading, um, until you're making tons and tons of money, so you don't have to stress about bills and stuff like that. And so you can also build up your personal capital. So you trade your own money. There's no made up rules of daily drawdowns or whatever. It's totally up to you. Full control, total freedom. You decide the risk per trade, drawdown tolerance, trade frequency, whether you want to withdraw that money or whatever it might be. You've got full control, and which comes with full responsibility of your money. But end of the day, it's just totally yours. It's 100% yours. So why personal capital wins in the long-term game. So it enables consistent risk management. So other than like unlike prop firms where you're risking like 0.5% or like 1%, even 1% is like honestly quite a lot if you're trying to keep the account for a while. You can risk confidently 2% with personal capital. That's no issue. It's lower emotional pressure, so you don't have to wake up wondering if half my accounts are gone because of some random silly rule from the prop firm they made. Where I mean, some of the things now it's like if you make 80% of your profits from one trade, like that's you're not allowed to withdraw that, and so which means you have to continue to trade until that like one trade doesn't become like a bigger portion of your profits. I mean, these people they make these rules up just to just to find a way to not pay you out and to not ban you. Uh, so what else personal capital enables so long term is strategy patience. So you just play the game, you play your strategy. You're not trying to hit a profit target. Staying patient and just letting the edge play out, sticking to your plan. And it allows for drawdowns without panic and position sizing aligned with edge. So um, if you've got a lot of trades on at one time, let's say you've got 7 trades on at one time, pretty rare for me, but I mean, look, it can happen. You've got 7 trades on a prop firm and you're risking 1%, and your daily drawdown goes to -6%. Even though you maybe didn't even lose a single trade, like you'll lose your account just simply because your daily drawdown has reached that 5%. So drawdowns without panic, and you can size correctly with personal capital with no issues at all, other than getting margin call and stuff like that. But that's topic for a different time. But yeah, this is where the true compounding happens. So the thing is, on your prop firms, like you got a 100K account, let's say you make 2 grand, that's paid out to you. You start back at 100 grand. Personal capital, if you don't need the money and you don't sort of pay yourself out, they'll just simply compound over time. And then after a few years at 100K, it might be 300 or 400K, whatever it might be. Um, it just lets the compounding do a decent chunk of the work if you keep your sizing correct. So instead of doing 1% risk on 100K, if you're at a 102K equity, you do 1% risk on 102K. So that keeps building up. So pretty much the key differences. So prop firms, they are a shorter term mindset thing. Um, I wouldn't mentally, I wouldn't believe that I'm going to be keeping the prop firm account for months and months. I mean, so you buy them, you pass them, you get payouts, you blow them. That's it. Like it's really just as simple as that. I mean, the prop firms, even the companies themselves, like begin to fall apart sometimes. So it's not even your fault. So you really can't think of it as too much of a longer term thing. Rule based survival. So as I said, like just those really weird rules where you kind of can't really trade freely. That sucks. It's an income focused, so it's instead of like a growing your wealth type of deal, it's more of a just get paid and use that money deal. And fragile accounts, so pretty much they can just take that away from you whenever they want. And then personal capital. So we've got it's a longer term mindset. So as I mentioned, the compounding effect of it, a bit more of a wealth builder type thing. I mean, you can go from 100K to 200K and then take out that 100K and do what else ever you want with it as a payout to yourself, but you do need a longer term mindset. Performance based growth. So look, you don't have anyone looking over your shoulders. You can just enjoy, just let your edge play out and just sticking to your plan, and then experience that type of growth rather than changing way too many different rules. I mean, you make 100 R a month, a year. With a profit, if you're risking like 0.5%, like that's 50 RR. Like you're already losing so much. With personal capital, you're risking 2% and you're making 200 RR. That's a 4x difference from 50 RR to 200 RR. So yeah, so it's got a wealth focus, and then it's more of a durable account. So yeah, as I mentioned, they can't just take it away from you. That's not a thing. Um, it's your money, your rules. Thing is, there's no one or the other. Like my recommendation, like of what I've done for myself, has been using both. So prop firms for cash flow and skill validation. So they're pretty good for fairly profitable traders or new traders that are somewhat profitable and back testing data. Like I don't, it's not a bad idea to use prop firms. Um, as I said, just because it's not your money and you can start with 5K accounts, 10K accounts, and then build personal capital for longevity, consistency, and freedom. So I mean, ultimately, once you've got that big fat lump sum of personal capital, like your options are endless. So pretty much the goal between using the two is prop firms to fund your life and to fund the personal capital that will build your future. Thanks for watching. Shoot me a DM, like and subscribe on YouTube. Shoot me a DM on Instagram. I'll answer any questions you guys have got. More than happy to review trades using the strategy I use, or any kinds of questions or comments you guys have. Feel free to shoot me a message. I'm more than happy to speak to you guys. Thanks for watching, and I'll see you in the next one.